Looking ahead this week, we have conference board, consumer confidence data, more leading type of data, Oz CPI, RBNZ, and UK budget on Wednesday. So Wednesday is going to be a really busy day, really, really important. And yeah, the beige book as well. Yeah, UK budget, that's going to be a big one. And RBNZ, of course, when thinking about that Aussie Kiwi trade that we've been eyeing up for so long. And then the Fed enters a blackout period, so nothing until the FOMC a couple weeks later. Probably quite thin liquidity towards the end of the week with the Thanksgiving holiday. Quick review of the data. Good rebound in non-farm payrolls, now at 62.3K, the 3-month rolling average. Still short of the 75K-ish, 70K-ish break-even rate that a lot of banks are estimating, but it's reversed a lot of this continuous decline that we've been seeing. Yeah, this rebound, if it sticks, could start to, in terms of the Fed mandate, focusing more on price stability. So still early to, that's certainly what I think they should do, but still early to say that based on the current evidence, just one report so far. And the October report is going to be interesting given that Challenger report saw a massive spike in layoffs. So still have the October report before I can really take that view with conviction, but that's my feeling at the moment. And yeah, we'll have to see. And then, of course, the wage growth running at 4% still, despite some other weaknesses. So something to factor in, I suppose. If wage growth is running at 4%, then you'd expect inflation not really to be falling all that much. But as we've seen in other reports, they're mostly, higher incomes are seeing strong wage growth. Remember that B of A spending report? They've shown a difference between higher income earners and lower income earners, and they saw a diverging trend in wage growth, and it was mostly the high income earners. GDP running strong, 4.2%. The economy still looks resilient. Retail sales still estimated to be strong. Walmart guidance was, quite decent, all things considered. So some resilience in retail sales and consumer spending. Data trends still looks pretty good broadly speaking. Global fixed rate, the G10 and the emerging markets, all generally holding up pretty well. But we are seeing a little bit of divergence here with the U.S. showing more resilience, while the euro, a lot of that momentum that we've seen a month ago has completely fizzled out, and China stalling out as well. G10 wise, most positive has been the yen and CAD, but yen, I'm not sure this does much to move the currency. We get some yen data later this week as well, some inflation type data. But when thinking about the DXY though, think DXY looks like it should stay supported despite the rate cutting expectations have moved more dovishly. But yeah, it's still holding up despite those moves. It did look weak when we did see that repricing, but it's caught up. And I think that's a lot to do with the data trends that we're seeing here. We're seeing that relative move, basically what we just saw in prior charts, but in a graphical view. And since July, we can see that the euro has been probably a lot better than what the data has been suggesting, at least in this view. And euro pound, I think it's more obvious here that the euro has been outperforming what's been going on in their relative data surprises. So now that that's turning, and there's also a few banks that have been talking about tactical downside in euro pound to the 86 potentially, 86 handle. I think that's a pretty good idea, and it's predicated on whether Reeves delivers a budget that does ease the worst of the deficit concerns. And if she does so, then they think that euro pound could trade lower from here. So I kind of like that idea, to be honest, because there's a lot of negativity priced into the pound, right? GBP data has been improving over, apart from what we saw recently, has been improving for a while. And then recently, obviously, we had some pretty bad labor market data. But yeah, I mean, you can see before that, there's obviously a lot of negativity priced in, despite some decent GBP data beforehand. Weekly price action, still not out of the woods yet, looking very, very weak overall. The US, I think there's potential for some stability, given that the equal weights are holding up better than their cap weighted. So a lot of that has been centered on the mega cap stocks and technology stocks selling off, obviously around AI concerns. I don't know. At this point, you'd have to think that a lot of it has been reflected in the price now. I would say that's my general sense for now. And then if we look at the breadth chart, that nice little thrust in the white one, which is percentage of stocks above the 5-day moving average, we've seen quite a huge push, and I think that's just Friday alone. We're starting to see it earlier in the week, and I thought that was going to be a positive. And yeah, nice little bit of follow through. The red ones, not so much the Nasdaq, but the S&P, we're starting to get back towards the 50 level. So we're almost there in terms of mean reversion. So I think this is going to be a big week. And when you think about what kind of narratives could derail the rally, AI concerns, yeah, that's already been the big thing. And what else is there? Rate cutting odds, I don't think it really matters whether they cut in December or not. And then we have Thanksgiving. And Thanksgiving seasonals is very strong. And it usually tends to set the scene for the year-end rally. So we're in the lead up now. And, after that sell-off, I think tactically you'd have to be a dip buyer here of risk, in my opinion. I mean, if it falls out, fine. You'll get them next time, but at these levels, and based on a little bit of what we saw on Friday and OPEX being over, which means a lot of that negative gamma, the pressure that's been weighing down on the market, now with a lot of that being lifted again, could allow equity markets to find some relief, in my opinion. Sector look, everything, it just looks pretty good so far. So yeah, I think there's reasons to be positive technically from this standpoint, even though the weekly bars look pretty horrible still. Commodities, copper, interestingly, does look quite constructive. That weekly bar showing a nice tail. Obviously, if copper is rallying, then that means general sentiment is generally taken to be good. And the CAD just following the dollar. CAD has seen some better data recently, and then dollar as well, catching a bit. Yen, not sure where the incremental move in 10-year and 2-year rates are going to come from in a way that it really changes things. Not sure what my view is on yields in general. I suppose that's what I'm saying. So yeah, Aussie I think looks good. Kiwi I think also looks good. We'll have a look at some charts. And I think euro and pound generally downside bias. I think pound is an interesting long tactically once the budget comes. A little bit of sell effect, maybe some hedges rolling off as a result.